Welcome, everyone. I am super excited to talk about taxes today because I have someone here from 1040 Abroad, which is a service that helps gringos or expats anywhere in the world with their U.S. taxes. So I'm going to jump in here and I'm going to introduce Olivier. And he is from, I assume you're French Canadian from Toronto. But Olivier, maybe you can just tell us a little bit about 1040 Abroad before we start asking you questions, because I see there's already questions in the box.
Great. I'm French. I'm not Canadian yet.
Okay.
I was born in France, French parents and everything. In 2004, I moved to the US. I was working in finance in New York. And after the financial crisis, I still kept my job, but the HR policies became unfriendly. And so I dreamt about having a business of my own and working for myself, being location independent, which was quite not as widespread as it is these days. And I'm not really an artist. I'm not really good at IT. I guess I could learn that. But I was good with numbers. That's what I was already doing. And so I decided to learn about tax. I became an enrolled agent in 2012, became a CPA in 2014. And right, so I'm preparing tax returns for Americans who live overseas, mostly in Canada. I have some in Mexico, some in Western Europe.
Okay, great. So um, I want to say hi to the first folks that are showing up here. So Rob from Wisconsin. I am going to be in Wisconsin next week, and actually we're going to do a little quick talk here because Olivier and I did not prepare all that well in the last 15 minutes because we've been talking about the strange connection we have not to Wisconsin but to another location. We're going to talk about that because we didn't finish our conversation. But Rob, I will be up in the Rhinelander area. Not sure if that's where you're from. So we see hola, we see yay, folks looking to become informed. Buenas noches from Connecticut. Hot Austin at 100 plus degrees. So thank you all for being here. And we are going to talk about our drinks. Not only the two of us, but anyone else who's on this call, because I have the perfect drink. This is my preview, the perfect drink for when it's 100 degrees out. But let's talk a little bit about tax first. So let's see here. Where should we start? Because I actually just signed up for your service about a week ago. And so I've got the spreadsheet that I'm typing away and trying to get the
Oh, you did
details in there.
great.
But yeah, maybe you can tell us, just kind of some of the top things that people need to know. And if you're out there in the audience and you have specific tax questions, I know I have some, type those in and we'll be pulling those up as we go along. But just maybe the key kind of overview of taxation when you live outside the country.
Right. When it comes to income tax, there's two ways to avoid paying US tax to income tax to the US. One is the defined income exclusion that most people know about, whereby you can exclude up to $112,000 of earned income, wages, self-employment income.
Oh, yeah. Thank you.
Yeah, I don't want to add my face. All
I
right,
was like, oh
perfect.
no, it's covering his face. Okay, this is better anyway.
So to qualify for the defined income exclusion, you will need to meet one of two tests. One is the bona fide residence test, whereby you are an actual resident of a foreign country, you're a tax resident, you pay tax if that country chooses to levy some, and you have connections with that country, you're on the ground at least 6 months. There's no clear cut as to how many connections you need, but everything helps. Have a stable immigration status, have a driving license, learning the language, have professional connections, personal connections, etc., etc. So that's the bona fide residence test, which again requires you to be, in my opinion, 6 months on the ground in that country, which would leave you 6 months to be elsewhere, either in other foreign countries or even the US itself. You cannot exclude income that was earned in the US. You can still use the standard deduction against that.
Well,
Right.
let's talk about that one because that one does. I live less than 6 months a year in Mexico, so I don't qualify for that. But do you have to be paying taxes in Mexico to be able to get that credit in the US?
Under the bona fide residence test, yes.
Okay.
Under the physical presence test, which is the other test to qualify for the foreign income exclusion, you don't need to be a resident anywhere. You don't need to pay tax. You don't need to have an immigration status anywhere. You can just hop from country to country as a tourist without ever. Sorry, I'm going to use that drink.
There we go. We will talk about those.
Right. Well, so you can just be hopping from country to country as a tourist without having a work permit, without filing tax returns with these countries. You might not be in compliance with the laws of these respective countries, but the US would still allow you to exclude foreign earned income under the physical presence test. Mm-hmm. That test requires you to be in a foreign country for at least 330 days in any 12-month period. So that's quite a bit more restrictive, obviously, as when it comes to the amount of time spent overseas. But the upside is that it's black and white. Either you were in a foreign country or you were not. If you qualify, you qualify. You don't need to have any ties whatsoever. You don't need to file tax returns or have a specific immigration status. But if you want to be a bona fide resident, then you need to be a bona fide resident of a country in particular. And in my opinion, you should be on the ground for at least 6 months.
Yeah. Okay, great. I think that helps me understand. And that is earned income. And
right. That's the foreign earned income exclusion that most people know about. When people contact me, they generally know about it. People are less aware of the foreign tax credit, which is best when you live in a country where the tax rate is higher than the US, because then that would fully offset your US tax liability. Mm-hmm. You get dollar for dollar credit for taxes paid to a foreign country. And the only requirement is for the income to be foreign and to pay tax to a foreign country. Mm-hmm. So it applies to passive income, it applies investment income, rental income, wages, self-employment income, an income that is foreign. Of course, there's quite a few tax rules to define what is foreign and what is US sourced. When it comes to wages, it's the location where you're located when the work was performed that determines whether it's US or foreign. So I have people who work for a US employer, they are paid in a US account, and it still qualifies for both the foreign income exclusion or the foreign tax credit, as long as they're physically located in a foreign country when the work was performed.
Okay, great. I think so. This is something that, like, if someone were to hire you and go to 1040abroad.com, you're going to help walk them through this, or how exactly does it work in terms of, like I said, I just subscribed or purchased the service, so I'm just in the beginning steps of filling out the spreadsheet of things, like in terms of advice wise, and helping people, guide people through that process of how to save money. Because not very many, most of us want to minimize our tax burden, and it gets complicated, and that's really what you're here for, is this complication.
Right. So you would contact me, you would, or my assistant, to be more specific, you would fill out the contact form on the homepage of my website. That would go to my assistant. She can answer most basic tax questions. And if you want us to prepare your tax return, she can set you up, and then we will take it from there. We'll have the tax return with you within 2 weeks. If you want to get on a call with me, she will give you a link to schedule a 20-minute call, which is free, to ask any more specific question you would have, or if people feel more confident speaking to an actual person.
Yep. Yeah. Well, we're going to get to some questions here in a second, but I want to take us to something silly that really doesn't have anything to do with taxes, but I think this is interesting. As we were talking right before we get together, right before this time together, and Olivier asked where I lived, and right now I'm in Portland. So I spend my winters in Mexico, my summers in Portland. I'm about to go back to Wisconsin. I saw that Rob was from Kenosha. I'm from Franklin, by the way, not too far from Kenosha. That's where I'll be spending part of my time in Wisconsin. and then doing some travels around the mainland of Mexico. And so to Puerto Vallarta, which you've been to, and Guadalajara and Querétaro and Mexico City. But when I said I was from Portland, Olivia said, hey, I was there just a week ago. Did you hear about the dinosaurs? So let me pull up the dinosaurs. Let's see here if I can. Let me put a background on here just to make this a little bit easier to see. Show that. Nope, it's not showing. That's okay. You can just watch half of me. So this is this big dinosaur, what not exhibit, but a world record breaking performance art, maybe, where 300 plus people, 350 people dressed up as dinosaurs in the center of Portland, Oregon. So this is Olivier here. And we figured out that just over to the right here is my wife and I. So how strange, what a small world. I just wanted to point that out just because it's just a fun, small world thing. So I'm going over to comments. We've got someone from Houston's coming. I want to get some tax questions from y'all. And then we'll be talking about drinks too, but put in those tax questions because we have Olivier here. You can get on a call, a 20-minute call with him directly, but there's a lot of general questions. And one of the things that I saw when I signed up was the FBAR, FBAR. Maybe you can talk a little bit about that and how that works, and I'll probably ask you some questions too.
Right. So the FBAR was created in the 1970s, which explains the threshold of $10,000. If you have more than $10,000 in a foreign bank account, you have to file an FBAR with FinCEN, which is it's a branch of the Treasury Department, just like the IRS is. So it's an informational form that's mostly used for anti-money laundering purposes. There's no tax owing on it, but there are penalties for failure to file an FBAR. Mm-hmm. So $10,000, which is easy to reach these days. The law came into place in the 1970s. In 2003, the IRS really started enforcing it, and people have been filing FBARs ever since. In 2011, FATCA came about, which is the cousin of the FBAR. At that point, they were smart enough to have different thresholds for people who live in the US and people who don't. So the threshold is $200,000 for people who live outside the US, $50,000 for people who live in the US. And instead of linking the information that was already submitted on the FBAR, they decided to create a new form that mostly reports the same information. And that's Form 8938 that is attached to your tax return.
Okay, so the FBAR is where you tell the US government, I have more than $10,000 in overseas accounts. Right. So you got money, you have it in Banorte or Bancomer, you've got money down there, and it exceeds $10,000 at any point in the year, right? So if you go over 10,000, that's when it qualifies, right?
So if we get into the specifics, so the $10,000 is the sum of the maximum balance across all of your accounts.
All of the accounts. So if you have multiple accounts, you have to add them together.
Right. So if you have $7,000 in an account and you transfer $6,000 to another account, the maximum balance of the first one will be $7,000. The second one will be $6,000. $7,000 plus $6,000 is $13,000. You will have to file an FBAR even though you never actually had $10,000. There's a little bit of lenience to make things a little easier. If you receive statements that are sent quarterly or more frequently, you only need to look at the closing balance of these statements to determine what the maximum balance is. So if you had a maximum balance during the statement, but it came back down, you wouldn't have to account for that.
I see. Okay, good. And one of the things I looked up today was I use Wise to transfer money back and forth. It's a very common service. I'm not sure how many other services are exactly like that, because if you use something like MoneyGram or Western Union, I think they just send the money from your US bank account to your Mexican bank account. Wise allows you to keep money in pesos in this. And so I have, essentially I put money into Wise and then I send it down to Mexico. And I usually play the game of when is the exchange rate best. So I'll transfer money into the Mexican account when the exchange rate's good. And then I've got pesos to spend, or I can transfer dollars in the future. But I noticed there that you do need to file an FBAR. The peso account in Wise does count towards that $10,000.
Right, exactly, yes.
So it is a foreign account if it's not a dollar account at Wise.
For most currency, they actually provide with local bank accounts. So you would have a local routing number and a local bank account. Not for all currencies, but for most they do. So yes, those would be foreign accounts.
Yeah. So this year I will be filing an FBAR, I guess. So, or you'll be filing one for me. You guys are being really quiet here. So I think the next thing we need to do once we transfer out of FBARs is to talk about drinks, because we need to get you guys back active in the comment section. So I want you to tell us what you're sipping for happy hour. And I'm going to tell you what I have here, even though Portland is cool today. There's people in Austin and Houston and whatnot in Mexico. This is a ranch water. And someone introduced us to this drink down in Mexico. And what it is tequila plus lime juice plus Topo Chico. And it's a very refreshing drink, just a little bit of that taste of tequila. There's a reposado. And so you can taste the tequila, but it's really just super refreshing for a cold day. So Olivier, you can talk. Everyone else has to type. So
right. So I have champagne glass, and for the video, I decided to be creative. I have some ginger ale to have some bubbles and some iced tea. So that's my drink of the day.
Wonderful, wonderful. Okay, so someone is drinking kombucha, which is a great drink. And I'm finding that more and more in Mexico, actually, which is exciting because I like kombucha. It's a great alcohol alternative. It still can be a tasty, good drink, and it's healthy. So I love that. And so someone says, did you pick someone watched the short video where I was going through earlier, trying to decide in my liquor cabinet what to drink. And I went with the tequila. So, yeah, so I'm very curious about the FBAR. I'm not sure if that came in. What exactly is it? So maybe we can talk about that a little bit more, just explaining the basics there.
Right. So these days, it comes in the form of a dynamic PDF file found on the FinCEN website. Until 2013 or so, it was a paper form that would complete on paper and mail in the postal mail. Now you will submit it electronically. You will go on the FinCEN website, download the form FinCEN 114, which is the FBAR. You will complete it, and then you will go back on that website to submit it.
Okay. So yeah, so essentially it's just simply telling the US government how much money you have, or what the highest amount of money you had overseas. And it doesn't affect your taxes. It's just kind of like they just want to keep track of
right, exactly. There's no tax on
where people have money. So okay, so Laura has a question here. I'm going to pull this out. Okay, I think I can show that. So there it is. So are typical U.S. medical deductions with services received in Mexico allowed to be used for tax credit? That is a somewhat complicated question because if your medical expenses exceed 2% of your income or something, you can use that as a tax credit in the U.S., I believe.
Well, it's 7.5% if medical expenses are more than 7.5% of your adjusted gross income. You can request an itemized deduction for that, and yes, you can claim that deduction for medical services received outside the U.S. With that being said, it's a fairly high threshold. Even after you meet the 7.5%, you have an itemized deduction. For it to be useful, you still need to beat the standard deduction, which for single people would be $12,000. So yes, you can claim medical expenses incurred outside the US as an itemized deduction. In most cases, however, the computation would not make it worthwhile because of the 7.5% of AGI, and then you still need to beat in the standard deduction.
Yes. Yeah. Things got complicated when they changed. I guess maybe things got less complicated when they made the standard deduction much bigger.
Right.
It made things easier for a lot of folks, but maybe making choices on taxes. Everyone's changed. We're doing this. My wife and I are doing the standard deduction now for the past few years, and before it was always, how much are we paying interest and what did we donate and all those kind of things. So it's kind of so folks are thanking Laura for her great question. And I want to throw out there. Wait, actually, I didn't hear what you guys are drinking. I know there's over a dozen of you here, so put in the chat box if you're having a drink with us tonight, because this is happy hour. So I'd love to know that everyone's participating. And I am going to be traveling, as I mentioned, around Mexico. So I'd love to connect with folks who are somewhere else in Mexico as I go. Maybe a little happy hour action as we go. I'll probably do a happy hour in La Paz the first weekend in August. I like to do happy hours in La Paz when I'm in town. So those of you who are from La Paz. So one of the things that is common amongst expats tend to be more interested in cryptocurrency than the population in general. So what can you tell me about cryptocurrency and taxes? I don't even have a question here because I don't understand it at all, but maybe if you are trading cryptocurrency, do you have to pay taxes on your gains?
Yes. So the IRS treats cryptocurrency as property, which means that you would have to pay to report the capital gain the same way as you would with other property on Schedule D.
Mm-hmm.
Well, exchanges tend to provide these statements, at least the transaction, buyout and sell transactions. They don't necessarily provide capital gain transactions. There are other websites that I would advise you to go to have on the same line in Excel the amount it was bought for and the amount it was sold for to compute the capital gain. So there's a little bit of a reporting complication there.
Mm-hmm.
Aside from that, it's a property reported on Schedule D, taxed at ordinary rates if it's short-term, long-term capital gain rates if you held it for more than a year. I know there are some countries in the minority, such as Portugal, that treat it as a currency and thereby are not subject to capital gains. Unfortunately, that's not the case of the US. And if you went to one such country to take advantage of that, well, guess what? You don't have a foreign tax credit because you don't pay a tax to that foreign country. In 90% of the case, you wouldn't have a case to sell it was earned income either. So, when the amounts are large enough, whether it's cryptocurrency, whether it's selling a principal residence, that can be the sort of things that push people to actually renounce US citizenship because they would face a large tax bill. So if you have a huge unrealized capital gain, you might want to wait until such time that you're no longer a US citizen to sell it. And at that point, you wouldn't have to pay capital gains, provided that you're not a covered expatriate, etc. If you're interested, book a call with me. Right.
Yes, interesting. So one of the things I heard you say there was that currency trading essentially does not have capital gains. So if I were to have bought pesos at 25 pesos to the dollar and then transfer them back into the United States at 20 pesos to the dollar or something like that, even though I've theoretically made money. We don't have to worry about that movement of money back and forth across the border that does, theoretically make money. We don't have to worry.
Right. It would become extremely impractical.
Oh,
It's
yeah.
not just trading currencies, it's just living, right? You're in Mexico, you receive wages in pesos, and these wages were worth something in US dollar at the time you received it. By the way, when you prepare the tax return, you can even use the average rate of the years that you don't have to do the conversion for every paycheck you received.
Mm-hmm.
But then you go and you buy something else, and the peso actually appreciated or depreciated. And like every transaction, every grocery trip to the grocery store will become a capital gain if they were to apply capital gains to currencies. And fortunately, they don't. But when it comes to cryptocurrency, unfortunately, they don't see it as currency, they see it as property. So that applies whether you exchange that cryptocurrency into fiat currency, US dollar or otherwise. It also applies if you actually make a purchase with cryptocurrency, right? If you bought $1,000 worth of cryptocurrency a few years ago, and now you're using that cryptocurrency to buy a computer that is worth $5,000, you have a $4,000 capital gain. It's that's just the way it is. It's not just conversions from cryptocurrency to fiat currency. It's also purchases. Then you would look at the fair market value of the goods you received for that cryptocurrency. So that's the problem that they avoided by making capital gains on currency not taxable that actually exists for people who were to actually use cryptocurrency as an actual currency to buy
So
goods and services.
if you're using cryptocurrency to buy things, I don't suppose it's not like you have a credit card statement or anything like that, or like if you were to have capital gains through E-Trade, say you'd get a statement that said, this is your capital gains for the year.
Right.
But with cryptocurrency, you're kind of on your own for all that, right? Like there's not a place that
you would have to look at the fair market value of that cryptocurrency on the day you bought such good or service. It's reasonable to expect that the good or service would be worth the same, right?
Okay.
But yes, the exchanges don't always give us this kind of statements. There are other websites that would take the reports you would receive from the exchange and generate a capital gain report based on that.
Okay, great. That's good to know. Good to know. So we've got a couple people with questions, but also some reports of what they're drinking. So Nomadic RV Living, I just love that the title there, I guess, or the channel name. I want to check that out. So we've got a Pilsner going there. Pilsner Urquell. I'm not sure how to pronounce that. But also we've got Laura is drinking a Dandy Blend coffee replacement drink. So that sounds yummy. Let's dig into Luke Patterson's question here. I haven't looked at the question. I'm just going to pop it up here and see what we have. Employee of a US-based company, living in Mexico and working online for the US company. At what point do I have to have exposure to Mexican income tax? Oh, this is a good question.
Well, if you're working in Mexico, you're subject to Mexican law. I don't know the threshold to file Mexican taxes, but in theory you would. Likewise, you would be supposed to have a work permit in Mexico. My understanding is that a lot of people in this situation don't actually go forward and file tax return with the Mexican authorities, and the enforcement on the Mexican side is also not the same as the US, to say the least. So practically speaking, I know that most people in this situation would not file Mexican tax returns, but you're under Mexican jurisdiction and they have jurisdiction to tax you.
Yeah, I think I remember reading somewhere where if you were there for 6 months or more, It's kind of those various tests, physical person test, whether your business or your place of business is there, and what's your permanent home and things like that. So, but I think you're right. There's an awful lot of gray area maybe that the expats operate in. So
Right, and that W-2 would be filed with the IRS. The IRS will use that W-2 to match it with your tax return. The Mexican authorities will not get a copy of that.
yes.
And if you're in Western Europe or Canada, I think that's if you were to get permanent resident status, at some point they will wonder what kind of income you're living on. But in Mexico, again, the enforcement is not the same, as I understand. As a general rule, like you said, once you spend 6 months out of the year in a given country, you probably became a tax resident of that country, and you would have to report your worldwide income to that country. As a U.S. citizen, you are a tax resident of the U.S. forever, or as long as you remain a U.S. citizen. And then that's where the source income comes into place. You would pay tax first to the country where the income is sourced, and you would claim foreign tax credit in the other country. So even though you would report your worldwide income to both, you would not be double taxed. You would pay tax to the country where the income is sourced, and claim a foreign tax credit in the other one.
So, and you're not a Mexican tax expert, but it seems like the Mexican tax rates are higher than the U.S. income tax rates. So likely if you're paying income tax in Mexico, you're not paying in the U.S. because you're paying the higher one.
Right, exactly. Those who live in countries with a higher tax rate and actually do pay income tax would be better off using the foreign tax credit, and then you don't have to count the days to meet the physical presence test. You don't have to make sure you have enough ties to meet the bona fide residence test to claim the foreign tax credit. You simply need to have a foreign income, be physically located in a country when the work was performed, and pay tax to that country. So in theory, if someone from San Diego was to work in Tijuana and pay tax to Mexico, even if they don't meet the bona fide or physical presence test, they would still get a foreign tax credit for the taxes paid to Mexico.
Yes. Okay, great. That helps. So another question from Laura is, these are great questions about tax applications for dual citizens that are making income in Mexico, example, Airbnb income from property in Mexico. Does that need to be reported to the IRS?
Yes. Again, as long as you're a U.S. citizen, you would be a U.S. tax resident. You would have to report your worldwide income to the U.S. When it comes to rental property, if you actually own that property, you would claim the depreciation expense, which would greatly reduce your rental income. And then of course that lowers the basis, and you will have that much more capital gain when you actually do sell it. But until then, you get depreciation expense, you get the foreign tax credit, you pay tax to Mexico, you get a foreign tax credit, a dollar for dollar credit for taxes paid to Mexico. So in that situation, obviously everybody's situation is different, and there is a possibility to have to pay taxes to the US. But generally speaking, people in this situation will indeed have to report their rental income to the US, but they will not have actual US tax owing thanks to depreciation expense and the foreign tax credit.
Yeah, and I think this probably wouldn't matter if you're a dual citizen, as long as you are a US citizen and you operate it. If you're making money in Mexico, this seems to be pretty clear. That seems to be the clear. If your money's coming from Mexico, you're supposed to be paying taxes there. That gray area comes more in your money's not coming from Mexico, but you're living there and you're doing everything remotely.
Right.
But it doesn't seem to matter your citizenship. What matters is you're a U.S. citizen,
right,
and you
exactly.
owe U.S. taxes. So can't get away from them. Yeah. Airbnb, that's one of the things. We don't rent out our property when we're not there, just to keep things simple and not to have to pay Mexican taxes, and because it seems like it's a little bit complicated. It seems, yeah, something that we're just keeping our lifestyles more important. We want to be chill when we're in Mexico, so we're not counting on revenue in Mexico from like Airbnb or whatnot. But I know a lot of people are. It's a very common thing. So let's talk about that. Housing. So say I sell my house in Mexico. And one of the things that's very interesting about this is selling property. Actually, the people we bought our house from were Canadian. So they were Canadians who bought the house, or who they bought the house. They had it for 15 years or something like that. And they paid, let's just keep it simple, 150,000 US dollars, which was, a certain number of pesos. Because there was an exchange rate at the time, which was, somewhere around 10 to 15 pesos. When they sold it to us, we paid about $150,000. The exchange rate had gone up to 2021. So in dollars, US or Canadian, I guess, they had zero, they didn't make any new money, and they didn't lose any money.
Okay.
Because, however, in pesos, they made a lot of money because they sold it for way more pesos, because the peso had gone down against the dollar. So this might be getting complicated, but so in that situation, the Mexican government said, you made money. We want our money.
Right.
But let's just say they were in the US and take Canada out and just keep things simple. Let's say, they had not made money in the US. So their capital gain was different in the two countries.
Right. Yes.
So they would have to pay the capital gains tax in Mexico based on pesos.
Right.
They would pay the capital gains in the US based on the fact that they paid 160,000 US for it, and the asset was worth 160,000 US dollars when they sold it. So they don't have a gain. Yeah, it's complicated.
Right. Exactly. For other income, you would use the average exchange rate. You receive wages, you even receive dividends, whether it was paid in March or November, you just use the average exchange rate for the year. But for capital gains, as you pointed out, it's the actual exchange rate on the day you bought and sold that property. And that means, indeed, that you can have a gain in one country and a loss in the other one, or a bigger gain or a bigger loss in the other. And so you cannot look at the tax rates the same way as you would otherwise and say, oh, they have a higher tax rate than the US, I'll have enough foreign tax credit. Well, in this case, they would have foreign tax credits that they can carry forward for up to 10 years that they might never ever use for. But if the reverse was true, if you have capital gain in US dollar, but you don't have one in the foreign currency, then obviously the foreign country will not tax you on that, because as far as they're concerned, there's no capital gain. But if they don't tax you, you don't get the foreign tax credit. And and obviously capital gains are passive in nature. They are not eligible for the foreign income exclusion because they are not earned. So yes, that's the sort of things that you want to get a pro forma tax return, see what that would look like before you actually sell the property to decide if you want to sell it, if you want to, I mean, depending on the amounts, give up your US citizenship, etc. I mean, I have this case a lot in Canada for principal residents. If it's a rental property or a place you don't actually live in, you'll be taxed from the first dollar. But if it's a principal residence, i.e. you lived in it and owned it for at least 2 of the prior 5 years, you get a $250,000 exemption. Well, here in Toronto, the real estate market has been going crazy for a decade. Everybody's been like, it has to go down, it never goes down, it's insane. Very few people can actually afford to buy apartments.
Mhm.
But the bottom line is that people have a lot more than the $250,000 of capital gains that they can exclude in the US. And the Canadian government does not tax the sale of principal residence, regardless of the amount.
Oh.
And so they don't have foreign tax credit, and so quite frequently people who are dual citizens don't really regard themselves as American and their whole life right here in Canada, choose to give up their US citizenship before selling that apartment such that it will not be taxed by the US.
Yes. Yeah. So maybe less of a problem in Mexico because it is a $250,000 gain credit.
Right.
It has to be your principal residence. So you'd have to be a resident of Mexico to get that $250,000 credit. And in Mexico, houses are just less expensive than they are in Canada. So where you're not as likely to be making $250,000. I guess it depends on how long you've lived there. And the other thing being that the peso tends to be less strong as time goes on. It's becoming less strong against the dollar. The Canadian dollar seems to be a little more similar to the US dollar on a regular basis.
Right. And since we're talking about real estate and Mexico, as you know, people, a foreigner cannot own real estate next to the coast or next to the border. And people create Mexican trusts, fideicomisos.
Mhm.
And they are complicated forms related to foreign trust. But thankfully, a few years ago, the IRS came out and said that if the trust was essentially a sham, really, meaning that the bank that is supposed to be the fiduciary didn't actually manage the trust, that the actual owner was paying the property tax, etc., etc., then it will not regard it as a trust, and you will not have to file Form 3520, 3520A that are generally applicable to trusts. That's some good news. The US will not regard the trust as a trust, and you will not have to file Form 3520, 3520A that generally apply to foreign trusts.
Okay, so that keeps things a little more simple. Thank you, U.S. government, whoever made that decision. So, um, yeah, great. So I'm looking through here. So Kathy Bird is drinking Samras coffee cream liqueur. I'm not sure. I'm not familiar with Samras, but I'm sure it's like Kahlua, but a brand from somewhere else. And I'm also a big fan of that. I drink a lot of sombreros, which is like a milk or cream and coffee liqueur. And it comes out, shows up nicely before you stir it up. So great. So I don't see any other questions here. So I'm going to look through my questions. We talked about the FBAR. We talked about the house. Yeah. Extensions. Let's talk about extensions. When do you have to pay your taxes?
You have to pay your tax on April 15. So interest will accrue from that point on. You can estimate what your liability will be and send a payment with your extension. If you owed more than $1,000 the prior year and you expect to owe more than $1,000 in the year you're filing, you also have to file to pay estimated tax on Form 1040 ES quarterly leading up to the next tax year. So that's the deadline to pay. They did make an extension in 2021 because of COVID, but generally this one is not extended. With that being said, when the amounts are small enough, there's a good chance you might get lucky and that the IRS would not actually request the interest because they have to send the letter, process the payment, etc., etc. So if it comes out to $50, they might not ask it, but I cannot guarantee whether they will or won't. So that's the deadline to pay. The deadline to file is June 15. You get an automatic 2-month extension, which I sometimes refer to as automatic, because you only need to be living outside the US on April 15 to get that extension to June 15. You don't need to apply for it. The one you do apply for on Form 4868 to October 15 is what I refer to as the automatic extension. You send Form 4868. If you expect that you'll owe tax, you can send your payment with it. And that extends you up to October 15.
Okay.
Then you can write a letter to get to December 15 because the 6 months extension you get to October 15 when concurrently with the 2 month extension. So you can write a letter to ask to get the 2 months back because you are using both at the same time. So that brings you to December 15. Also, if you expect to meet the physical presence test of the foreign income exclusion, you can use file 2350 to get an extension to any such time that you will meet the foreign income exclusion. So, right, like I said, if you use the physical presence test, I'm getting a little geeky here, but right, if you move to Mexico on December 1st or December 15th, you can use the physical presence test as long as you spend 330 days in any 12-month period in a foreign country. So that 12-month period can go from December 13 to December 12 the following year. Now, you need to have met the physical presence test at the time you file your tax return. Your deadline is June 15. You will not have met the physical presence test then. The extension to October 15 still does not have the full 12-month period for you to meet the physical presence test. So you can file Form 2350 to ask to get an extension to even January of the following year to file your tax return because you need to meet the physical presence test when you file the tax return.
Well, that is great because I think we were in Mexico April 15th, and I filed the whatever Form 10 or 8 something blah 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 to get an extension, which takes me to October 15th. But interesting, and that was just because I didn't have all the papers that had been mailed to the United States and whatnot. I was like, oh, this is too much. And now I'm like, okay, I got to get around to actually filing my taxes for this year. And I think of that mostly as just a convenience thing, but I never thought of it as a strategic thing to essentially say that you can move your tax filing deadline to benefit your tax status. They still want their money on April 15th, but it's interesting that you can use that. And that's something where I think a tax professional can really help, is to say, okay, well, this is your situation. This is going to help you save. So, and let's talk about savings. What, saving money, that's part of the, idea behind hiring someone who knows what they're doing with taxes. So what are maybe some savings that people, besides the foreign income, earned income tax credit, and those couple that always pop up, are there just little strategies or something that folks should be considering?
Well, I think we already discussed everything there is to discuss when it comes to income tax. We have not talked about Social Security.
Okay.
And if you're self-employed, you're subject to self-employment tax, which is 15.3%. It's the same rate as if you are an employee. The filing is a little simpler. And people who live in countries with the totalization agreement, Western Europe, Canada, are covered by the totalization agreement, and that means that they have to pay Social Security to the country they are resident of, and they're exempt from paying Social Security to the US. So interestingly, while the US and Mexico negotiated a totalization agreement in the 1990s, it still has not been ratified by Congress. Therefore, it doesn't exist. Which means that if you're self-employed and you live in Mexico, you you will be subject to self-employment tax. Now, if you are an employee of a foreign corporation working outside the US, you are not subject to US Social Security. So people who make more than, let's say, 60,000 US dollar a year might start. Well, you should contact me and we'll discuss it. But we can start investigating the possibility of creating a foreign corporation, being your own employee, and therefore not paying Social Security. Obviously, if you don't pay Social Security, you don't accrue Social Security benefits. But my clients, I found that typically are more interested in simply not paying Social Security. If you make less than $50,000, it's not really worthwhile, because while you would save on Social Security, there's all of the compliance costs associated with having a foreign corporation that would outweigh the benefits.
Mm-hmm. Yeah, that's great. So Nomadic RV Living, let's pop this up, has a question about using Airbnb receipts for your physical presence test, or do you have to have a lease? So assume here what we're saying is that you are renting an Airbnb for physical presence test. Is that 306 or 330 days? I can't
Right,
remember.
230 days, yeah.
Okay. Or do you have to have a lease to prove that?
Oh no, you can prove it any way that works. So Airbnb would work, a long-term lease would work. You can, for people who travel a lot from country to country, again, the physical presence test does not require you to be a resident anywhere. What I did when I was in that situation is that I took photos of my boarding pass and my passport stamps. I created an Excel file with the countries I was in. If you're in a country for an extended period of time, yes, Airbnb, lease, or even, bus tickets, domestic plane tickets, anything that has your name on it and proves that you were somewhere, would be used to show that you met the physical presence test.
Okay, good. That's good. Yeah, I think that's helpful. So it's not necessarily showing your residence, it's showing the fact that you were there. So this could be receipts, like you said, bus tickets and things like that show that you are the person and you are moving around within that country. So you clearly are not.
If you don't know, I know it takes them a couple of months to get back to you, but if you are not sure, you can even file a Freedom of Information Act request with Homeland Security to know the times you cross the border.
Interesting. Okay. The times that they know. Okay. That is a good to know.
Yes, they know. Every time you enter the US, they scan your passport and it leaves a trace in their system. Yeah.
Yeah. But they don't necessarily scan when you leave. So they don't know, when you walk out of the US, they don't know which, if you've left a day after or 30 days after.
Right. That's right. Yeah.
So, okay, so Laura's giving us a thank you. It looks like she might be signing out, but I want to pull up Kathy's question. So Social Security as income, so you're earning your Social Security back. Is that subject to Mexican taxes? Do you know that answer?
No, I do not. You would report it to the US. You would file your US tax return. I know that people in that situation generally do not file Mexican tax returns. I don't know if that's based on Mexican law. If it was taxable in Mexico, they would still give you a foreign tax credit for taxes paid to the US. I have to admit that I'm not intimate enough with Mexican law to say whether it's taxable in Mexico or not. But even if it was, you would not be double taxed. You would still get a credit for taxes paid to the US. And practically speaking, people in that situation don't file a Mexican tax return. I don't know Mexican law to say whether they are just taking advantage of the lack of enforcement, or whether that's actually covered by, there's an exemption in Mexican law to say that it's not taxable.
Mm-hmm. Yeah. So, well, thank you so much. We're coming close to the end of our time together, and I just want you to kind of give a little pitch for 1040 Abroad. I've got your website here so that people know what they're what they're seeing, where they can go. So yeah, tell us a little bit about your business and how people can engage you.
Right. I've been preparing tax returns for Americans overseas ever since 2012. I became an enrolled agent in 2012, became a CPA in 2014. I am an expat myself. I started out French. I became a US citizen in 2009, and I'm living in Canada now. I was traveling all over the place. I went to 30 countries in 2016. I went to maybe 50, 55 countries in total over the past few years. So from 2015 to 2018, I had this nomadic lifestyle. I moved back to Canada in 2018. In any case, that's my personal life. I help US citizens overseas with all sorts of situations, whether they want to announce US citizenship, whether they have or plan on creating a foreign corporation, and as well as all of the situations we talked about. So if you have any question, fill out the contact form on my website. My assistant will get back to you. If you want to get into a free 20-minute call with me, she will give you the link to schedule that. And there's no obligation whatsoever for that call. You would talk to me. I would answer your tax question, tell you the services I offer. I can prepare timely tax return. I can prepare streamlined packages. So the streamlined package is for people who have been overseas for quite a few years and and have not filed tax returns. So that's a procedure that the IRS created to get into compliance that requires the filing of 3 years of tax returns, 6 years of FBARs. If you want to announce your citizenship, you will need 5 years, but we'll discuss that more in details. During that free call, 20 minutes, I'm yours for free. You can ask me any tax question, and you have no obligation to hire my services after that. Great, thank you.
Okay, wonderful. Thank you so much. And 1040abroad.com is that website. And I do want to remind people that if you're not already a subscriber, make sure to click the subscribe button and the little bell icon and the little all words so that it tells you when new videos are coming out. I'm excited to bring you this content for folks who are, especially folks who are trying to get overseas before they retire. That is my ideal the person that I want to help the most, because I think so many people wait to retire and then move overseas, but there are a lot of opportunities to do this earlier than most people think. But if you haven't done it yet and you're already retired, come on down to Mexico and do it. Like I said, I'll be traveling around for over the next month or so throughout Mexico. So you'll be seeing some videos from different places. But hopefully you can reach out to Olivier with any questions you have about taxes, and reach out to me for any questions you have about what did I call this thing? Ranch water. I'm down to the end of my ranch water, so we must be getting close to the end of the video. But thank you all for being here. Thank you, Olivier, for joining me live from Toronto. And maybe we'll see you. Oh, I guess WDS, the conference you were here for that had the dinosaur costumes. That was the last year of that conference.
Was the last year.
Maybe there'll be something to come after that from Chris Gillibo, the author who runs that conference.
So. I hope so. I think he wants to take a lower profile, but I'll be happy to join whatever he does.
Yes, wonderful. So thank you so much. And we'll see all of you in the next video. Oh, we've got comments. And then, yes, thank you. This was great. Thank you. Okay, bye-bye.